Hello, everyone. Welcome to our SCORE webinar. We will be starting in about 1 minute. Hello, everyone, and welcome to today's SCORE Fairfield County's live webinar on choosing the business entity structure that is best for your business. I'm Bob Hogan, the webinar coordinator and a business mentor here at SCORE Fairfield County, and I'll be your host today. Our presenter today is Joe DeGostin, and more on Joe in just a minute. First, some brief information on SCORE. SCORE is a national organization with 320 offices across the country and over 11,000 volunteers, and we are part of the SBA of the federal government. Locally here within SCORE Fairfield County, we have over 130 volunteers with a wide range of industry, process, and subject matter expertise, and we offer 3 primary value-added services to small business owners. We offer free one-on-one counseling individually, and that could either be face-to-face, by telephone, email, or Skype, and you can access that counseling by requesting the mentor link on our website. We also offer over 150 educational workshops and webinars, and lastly, we offer extensive resources on our website, including a network of subject matter experts at your disposal. Our next webinar will be 2 weeks from today on Tuesday, February the 5th, and the topic is Conversational Marketing, Grow Your Business Socially with Facebook Messenger, with Greg Ruiz presenting. Look for the specifics on our website at fairfieldcounty.score.org. Just want to give you some information about today's events. We have set aside about 10 or 15 minutes for questions at the end of the presentation. If you have a question, please use the chat window at any time during the presentation. It's located in the lower left-hand side of your screen. We will end today's webinar sharply at 1 o'clock to respect your time. The session is being recorded, and a link to the recording will be available on our website, fairfieldcounty.score.org, within the next couple of days. And you'll be able to access not only the recording but also the slide materials. It's now my pleasure to introduce our speaker. Joe DeGostin has over 45 years' experience in accounting, auditing, and taxation. He retired from the IRS in 2008 after 21 years as a compliance auditor. Joe has been an adjunct at Fairfield University since 1972 and Manhattanville College since 2009. His business career began with Arthur Andersen Co as an accountant and a computer audit specialist, and he then worked at several companies as a controller before joining the IRS in 1987. I'll now turn it over to Joe. Joe, all yours.
Welcome. Welcome to the little workshop here on choosing a business structure. You can see the last line on the current slide has my phone number. So after today, if you need to get me, that's my cell phone. The only thing I request is that you do it after 5 o'clock any day of the week, weekends, except Tuesday or Wednesday. To begin with, I'm going to have a few introductory comments to put us in the right frame of mind. First, it's never too early to form an advisory team. The team would be people such as a CPA, a lawyer, a banker, SCORE, and some business associates. And you might think of it as your little board of directors. You know, whether you do that before you choose a business or once you're in business, it doesn't matter, but it's a good sounding board. The second thing is you can't avoid taxes when choosing a business form. So you should know your current tax situation and then project if the business that you are contemplating will have a profit or a loss. What is it going to do to your tax return in the next couple of years? Next, do you want limited or unlimited liability in regards to your personal assets? meaning your house, your bank accounts. So limited liability means you basically put a brick wall between the business and your personal assets. Unlimited liability means if something goes wrong and people want to sue you, they can go after your personal assets, your bank accounts, etc. Next, forming a business is going to expand your current 1040 tax return. So you may have to file additional schedules and even additional returns. And then lastly, you could be, depending upon your business, you could also be a collector of sales tax for the state that you're in. And if you have employees, then you're going to collect federal withholding tax and whatnot for federal and state, and then unemployment tax. And usually these things have to be forwarded to these organizations on a quarterly basis. So it's going to really keep you busy. And the one motto that I always have that I learned over the years is follow the cash. Cash is king. So on a day-to-day basis, once you're in business, know what your cash situation is. All right, the next slide that I'm showing you here, these are the 7 choices that you have. And what I have done in summary form, I've named the particular business entity, and then I've shown the tax ramifications of it. We'll be discussing the advantages and disadvantages down the line. So the first one is the sole proprietor. You're a one-person organization. What you're going to fill out additionally is on the 1040 a Schedule C. If you're a partnership, meaning you're multiple people, then you have to fill out a partnership return, which is called a 1065. And with that, you're going to submit what we call Schedule K1. The K1 divides the profit and losses among the partners based on what they decide the percentages are, and the K1 is reported on the 1040 Schedule E. If you're simply a landlord, you rent out a home or, say, a floor on your own house, then you're going to fill out 1040 Schedule E. If you choose a corporate form, you have 2 choices, Sub S, and you're going to fill out a corporate Sub S return. It's called 1120S, and they also have K1 similar to the partnership. And that goes on 1040 Schedule E also. Our pure regular C Corp, as we call it, that's an 1120C. And next, the LLC, that's a limited liability company. You have choices. If you're a single member, you could be a sole proprietor. If you're a multiple member, you have choices. You could be a partnership, a Sub S, or a C Corp. And then my students in class asked me to add this, is that some of you may decide that you want to open a nonprofit business. Most of the nonprofit businesses usually choose a C Corp, and then they still have to file a tax return, and it's called a 990. And if it's a nonprofit, the code section is a 501c3, and what you do, you can't just want to be a nonprofit. You have to fill out Form 1023, send it to the IRS, and the IRS will approve you as a nonprofit. And in terms of becoming a legal entity, remember, you're filing and registered with the state. The IRS does not approve you except for that nonprofit. All the other entities, they're approved by the state. Now, in running the business, you have to ask yourself a lot of questions in order to determine which entity. Are you going to be part-time or full-time? Are you going to take a salary or not? What is your primary source of income? You're going to work at home, or you're going to rent? Is a website needed? Where are you going to get the starting capital? Do you need outside consultants, accountants? Is an accounting system needed? How many hats do you wear? Do you need other consultants or specialists? Can you afford employees? How much of a nest egg do I have? That means when you start the business, cash is king, and a lot of the experts recommend not taking a salary for 6 or 9 months until you get your feet wet and you see what's going to happen to your revenue and expenses. Now, a lot of people forget about what we call self-employment tax. If you're self-employed, meaning that you're not a W-2, so you don't work for an employer, you don't get a W-2, you get a 1099 from them. So the entities that have this are the sole proprietor and the partnership. If you make a profit, you're responsible for paying Social Security and Medicare, but it's the full amount. You're wearing 2 hats. You're the employer and the employee, and that comes out to about 16%, and it's on the first $132,900 in 2019. So people forget that they have to do this. You don't have to send it in during the year, but when you do your tax return, there's a line on there, and you're going to owe that amount. So it's good to keep track of what's going on, and if you want to ease the pain in cash, then file estimated taxes. And again, the sole proprietor and the partners are subject to this. A W-2 person is still paying the 16%. When you're a W-2, 8% is deducted due to it's called Social Security and Medicare, and then the employer pays another 8%. So in both cases, 16% goes into Social Security on your behalf. The other buzz term that we talk about is what's a flow-through, pass-through entity. All the entities that we mentioned, okay, except the nonprofit and the 1120C are flow-through, meaning they're going to appear on your 1040, which is good in that the profit as well as the losses go to your 1040. So don't be scared if in the beginning you have losses. You're still going to get the benefit, and on your 1040, those losses will offset what other income you have on your return. The 1120C is not a pass-through, so all profits and losses stay with the 1120C. Now, the good news, thanks to Mr. Trump, is that the tax rate for the 1120C beginning in 2018 is now only 21%, which is very low since the individual, the 1040 rate, can be as high as 37%. Now, estimating your income statement in the 1040, I mean, if you're planning to form a business before you even, go to step 1, you should do a financial plan, 2 years or longer, and what you want to do is month by month. And you want to emphasize the income statement because that shows the profit or loss. And it's good to put it on an Excel worksheet, put your history on it, and then flow it forward and see what happens and see the effect on your 1040. Okay, and remember again, the 1120C has the 21% tax rate. Now, if you have a loss on the 1120C, that loss can be used in the future against profits. So the loss is not eliminated; it's just postponed. Now, how to choose the entity? It's not an easy task, but basically, I've been told that it's almost like saying, "What's the favorite ice cream that you like?" Remember, you're deciding what entity you want to be in, so you have 51% of the votes, okay? But we're going to review the 7 choices and look at the advantages and disadvantages of them, and from that, then you actually decide. But don't forget about that little committee that we decided in the first. I mean, use them as a sounding board to make sure you're going down the right route. And if you choose an entity, and then your business goes on, the tax law may change, you're not married to that entity. You can change that entity in the future, okay, based on situations and, as I said, the tax law. For instance, in 2018, Trump changed the 1120C to 21%. So we anticipate accountants being very busy and lawyers helping people possibly change to an 1120C now, being that the rate is low and they're highly profitable. Now, forming the business requires legal steps. The legal steps are not with the IRS. They're basically with the state. Now, right now at this moment, if you chose to be a sole proprietor or a partnership, you can do it. Just talk to yourself and say, I want to be a sole proprietor, and you are. There's no approval of the state or anything. A partnership, that's a dangerous route, being that you're going to have a group of people, and of course if they want to form a business, they're very happy, they're very friendly, but you need a partnership agreement to handle the situations down the road when there's disagreements. So you might think of it as a prenup. Plus, partnerships don't exist forever. Partners want to leave, partners die. So in the partnership agreement, you should have the specifics of how the partner who is leaving gets their capital, their money, out of the partnership. So the Internet has many tools where you can file and register. And it's a big business, and I want to emphasize business. So you can go on the Internet and use these tools. They're going to charge you. And it's not face-to-face. It's just chat room. So although it's available, I think it's more prudent to do it locally, face-to-face with someone that could advise you. And then you're going to have that as part of your team, and they're going to be with you and know your business down the road. Now, the EIN, that's called an employer identification number. That is issued by the IRS, okay? Now, you don't apply for that until you have your legal entity, okay? And the reason you need that, okay, is that if you're going to open up a business bank account, you don't use your Social Security number, you use your EIN. If you're hiring employees and down the road you have to file 940 and 941 to the IRS, you don't use the Social Security number, you use your EIN. And if you file a tax return, such as the 1065, the 1120C, and the 1120S, you use the EIN. Now, you can get an EIN very easy. It's an SS-4. If you go to the IRS site, irs.gov, you can actually call them, and they'll give it to you over the phone. Although we can't do that right now with the furlough because they're not answering phones, okay? But so if you wanted it, you'd have to send in the SS-4. Now, once you get approved for your entity by the state, they give you an ID number. Their ID number is for different purposes. Number one, they're interested in whether you're going to have to collect sales tax for them. And then if you have employees, the state also gets, you pay the unemployment tax when you register. So you're going to need your state ID number for those purposes. Now, I didn't know where to put this, so I just put it at this time, like we're about third through the slides. These are just some tax reminders that came about because of Mr. Trump. On your 1040, there used to be an exemption deduction. For each person on the return, you would get a deduction of $4,050. I think in 2018, it was supposed to go up to $4,150. That's gone, okay? Now, the standard deductions, they have almost doubled. So for each category, they've increased. So if you're single, now that's $12,000. If you're married filing joint, that's $24,000. And if you're head of household, that's $18,000. And if you're over 65, there's another $1,200 or so. I think like a married filing joint, both over 65, it's about $26,200 or $26,400 in terms of. So Trump is anticipating a lot of people who itemize taking the standard deduction. And those that took the standard deduction will continue because the amount of the deduction is double. Now, if you itemize on your return, the section that says taxes, Trump put a cap on that. So that section had property taxes and state taxes. So like a neighbor of mine is middle-aged, his wife and he both work, and he owns a house. And what happens is that the state tax that he pays to Connecticut and his wife, plus the property taxes, are capped at $10,000. Now, in a lot of cases, property taxes are close to that alone. So that's not too good for the middle class people. At the same time, the child credit went up to $2,000 from $1,000, but that's only for children under 17. Okay. Now, moderate good news for us is that the 1040 tax rates dropped 2%. So for each category, so they only go up to 37% instead of 39. Not as big a drop as from the 1120C. There may be a new schedule to prove that you're head of household. The good news for the flow-through, the Schedule Cs, the partnerships, if you make a profit, you get on your 1040 tax return a calculated maximum 20% deduction of the profit. So there's a worksheet to do that. So that was meant to help you get closer, although you'll never do that, but get closer to the 21% tax rate that the 1120C has. If you want to keep abreast of the changes and what's going on, there's a website. You can always go on, just www.irs.gov, and there's a wealth of information, and you can even sign up for some daily and weekly newsletters. Now, the 1040, as we know it, the old one was 2 pages, 80 lines. So Trump sold the new one as a postcard. So the postcard does have less than 30 lines. But the first time I saw it, I scratched my head. I didn't know how to read it. And the reason is the new postcard is only 30 lines, but it comes with 6 new schedules. So when you add the lines on the 6 new schedules to the 30 lines, you're almost back to the 80 lines. And the 6 new schedules just make things more complicated. But it is what it is. This is what we're all stuck with in filing our 2018 return. So now we're going to start with the advantages and disadvantages of the different entities. So the sole proprietor, you're one person, but you can hire employees. But you're the boss, full control. It's easy to form and low cost, meaning you can just do it and say, I want to be a sole proprietor. You can sell what you want. You can come up with doing business as a business name if you want. The taxes for 1040 Schedule C, I think it's buried here, but it's an IRS code section, Section 183. Just to make you aware of it, that the IRS can challenge the Schedule C, the sole proprietor. Are you really a sole proprietor? Many people work full-time and then they have a hobby. They raise goats or cattle or something. But the good news is that for the IRS to challenge you, they have to keep track of your business for 5 years. So they don't have the time to do that. But if they challenge you and prove that it's a hobby loss, then you're only allowed to deduct expenses up to the revenue that you collected. Okay. Now, the disadvantages of the sole proprietor, you wear all the hats. Okay. You do the bidding, you do the collecting, you do the selling and whatnot. And then you have your SE tax on the profits. It's actually 15.3%, and in 2019 it's $132,900. Unlimited liability. So the way my professor used to say is that they can come after the house, the dog, the cats, anything that you have if you're considered negligence and they're suing you. Continuity isn't a question because you're the sole proprietor. It's your business. So if you close it or you die, the business goes with it. Usually as an individual, it's difficult to raise capital. If you have a home or something and you go to banks, normally they would want to use your equity in your house as collateral for the loan. And you, if you go out of business, you close it, you cannot collect unemployment. So the next one, partnerships. More than one person, the choice is a partnership. Don't let the categories confuse you. Most partnerships are general partnerships. And then you may get a bill from your doctor or dentist, and you may see LLP. That's a limited liability partnership. And in the past, they had unlimited liability. So, and it's only open to certain professionals, attorneys, physicians, dentists, accountants, etc. And there's a special tax rate for them. So I just throw that in there from a technical point of view, not that you really have to know that. Now, obviously there's advantages to having more than one person on your team. 2 or more heads are better than one. It's not difficult to form. Again, you could form it just vocally if you want, okay? But it's not advisable. If you have more than one person, it might be easier to attain capital, and you could attract people with different specialties. Your affairs are private. You must file the 1065 tax return. That is not taxable, but then each partner gets the K-1 for his share of the profit or the loss, and that goes again to the Schedule E. The disadvantages, again, you're responsible for the actions of each and every partner. So it's joint and several liability. So that's a biggie, the unlimited liability. And then for the amount of profit on the K-1, you're going to have to pay, each partner has to pay an SE tax. Obviously, if there's a loss, there's no SE tax. There's also risk of disagreement and friction. So to clarify these and to settle them without going to court, you should have a partnership agreement. And it should be as detailed as possible. If you don't have one and you go to the court's just going to settle things equally, no matter what. Doesn't matter. If you have a partner that leaves, and it could be due death or they just want to leave, then you must value the partnership on that day. So you need a good accountant, either internally or a CPA that can do that for you. Losses in the partnership are only allowed as a deduction if you have basis in the partnership, meaning you have capital, you have money in the partnership. If you contributed to the partnership, then you took all your money out, you have no basis, so the losses get postponed. And what you have to do for each partner, for us accountants, it's not difficult, but you have to have a capital account for each partner. And it's a history. It shows for each partner what they put in, each year what the profit or loss of the partnership, what was distributed to them, and that's basically the basis accounts. Okay. Now, the K-1, it goes on your 1040. So even if the partner didn't take that money out, he still pays taxes on the K-1 amount, not on what he took out or didn't take out. Now we're going to continue with some disadvantages. No, I'm sorry. C Corp. The C Corp, that's the 1120C to file your taxes. The only form of business subject to the 21%, which is a nice low tax rate these days. Now the owners, the shareholders, they're referred to as employees of the company, and they work for the company, but basically they get paid through a W-2. Okay. The other factor about having a corporation, it is, as we'll see, a little more costly to form. there's more information needed, certain forms and whatnot. But it has limited liability, perpetual existence. Remember, the corporation lives forever, so those shares that you get when you own a corporation, you can give them to a beneficiary and they can continue the business. And we've seen this recently in a few, I think, professional teams. I don't know whether it's the NFL or the NBA, where the owner died and now the sons or the wives are running the team because the shares of the corporation were left to them. And many states allow a one-person shareholder. So you could be one person, okay, you're the president. I worked for a company for 10 years, and the president was a corporation. The president was the 100% owner, and there's nothing wrong with that. The only thing he had to do is he had to hold shareholders meeting once a year, just like the bigger corporations. But being that he was the sole owner, if he decided to bring in someone else, then he had stock to sell to them in a negotiated basis. And in the 1120C, your fringe benefits are deductible: employee medical, disability, group term life, which is a nice advantage. Now, the disadvantage that is always brought up, and it's sort of a misnomer for small corporations, is the double taxation of dividends. Now, if you're Apple or Microsoft, you issue a dividend. So those big public companies and the private ones we're talking about now, you don't get a deduction for your dividends. But Apple and Microsoft are different than a $5 or $10 million company. The $5 or $10 million C Corp is not forced to issue a dividend to the shareholders. So if you have extra money coming, there's ways to basically get a deduction for that and reward those who earned it. So you can issue bonuses, salary increases. You may decide to open up other benefits, such as a 401k. So because you're a small corporation, you're really not in this arena. You wouldn't do the issue a dividend. It's expensive to start. Some lawyers have given me estimates anywhere from $1,500 to $5,000. Certain forms, articles of incorporation, stock certificates, minutes that have to be filed with the state. Losses stay with the corporation. This is not really a disadvantage. I don't know why I put it in here. Profits are tax. I guess taxes is a disadvantage, but we all have to pay taxes. There's no way to get around that. It's the bureaucracy, so you're subject to state and federal forms. Every year there may be, there are fees to file and update the fact that you are a corporation. And you're required to have an annual meeting, but that's the shareholders. So basically you'll probably be under 10 people in these small corporations, and that's not a major problem. Now the sub-S, that's a corporation and has all the benefits of the C Corp, but basically it's a pass-through. Now the only requirement for the 1120S, or that you should keep advantage of, is that the people that are working there, they should be paid a salary, because most sub-S's that I've seen in my days with the IRS, their profit and loss came down to almost a break-even, zero or a slight loss, because anything they had, they paid in salary to those people. Now, if there is something left over, or profit, then the sub-S isn't taxed. That goes on the K1 to the shareholder. And basically the K1 is considered a dividend. So although it's not a deduction to the sub-S, the K1 dividend that goes to the shareholder is not subject to SE tax. Now, the one drawback of this is that you're limited to 100 shareholders and one class of stock. And you must be a U.S. citizen, so you can't bring in any foreign companies or people into your organization. The other thing that hassled a lot of people when I was with the IRS, is to qualify as a sub-S, there's a time period where you must file Federal Form 2553, and that gets approved, and that says that you're a sub-S. So a lot of people are not even aware of this, and these days the IRS is a little more merciful and is helping them out in filing it. But in the past, if they didn't file that, then they wouldn't be a sub-S. They would go right to an 1120C. What else do we have here? There's certain rules. I'm not going to badger them of that 2% shareholders under or over are entitled to or not entitled to. So we're not going to go into that sort of technical, but just so you know that. It's something that your lawyer or CPA should know that like the back of his hand. But benefits such as schooling, tuition, they are not income and deductible by the sub-S, where the 2% items, they would be considered income and added to the particular shareholder's W-2. Okay. Moving on. Passive income. That's a dirty word. Very confusing, but I put it in there because if no more than your 25% of the gross income must be generated from passive income. Passive income is real estate payments, royalties, and dividends. And basically, that's a very confusing law with the IRS, but passive income has to be reported, and if you have a loss, passive losses cannot be taken, only against passive income. So passivity means that it is a business, but you don't materially participate. Now, these are very technical words, and they're defined in the IRS. So if you're venturing down this sub-S corporation, this is something to ask your lawyer and your CPA about so that you don't get in over your head before it's too late. Again, it's really restricted to rental, royalties, and dividends. Okay. Okay. Now here's the best flavor that's come out in years. Over 2/3 of the new companies choose LLC. So you venture around and you see many trucks, especially plumbers, carpenters are now these days. They used to be sole proprietors. They're all LLCs, okay, limited liability company, which means if they're negligent, you can only go after their assets, not their home, and et cetera. Each state has its own LLC rules, but they're pretty similar, okay? The reason they have their own rules is that to qualify as an LLC, you apply to the state where you're doing business. Now, Europe had LLCs many years ago, and in Germany, at the end of a corporation, you might see the word GmbH. That's where the USA stole the LLC. GmbH is the LLC of the European companies. Wyoming was the first state in the United States to incorporate LLC. That was 1977, and then others followed in the 90s, and by the year 2000, I think all the states basically had an LLC. It's easy to form. You can most states have their applications, but again, if this is your first venture into business, it doesn't hurt to seek your team of people, either SCORE, your lawyer, or your CPA. The form is basically easy. There's a fee, but you want to check to make sure that you've handled the forms correctly. It has limited liabilities. The owners are called members. Now, if it's multi-members, you have great flexibility. You can be an LLC, multi-member, then you have your choice. You could be a pass-through Schedule C if you're a single member. Multi-member, you could be a partnership, an S-Corp, or a C-Corp. okay, and the LLC is not taxed, okay. Now there is a special form 8832 if, let's say, you start out as a single member LLC and you fill out Schedule C, but then you decide to take in a couple other members, so you want to become a partnership. So that LLC can become a partnership, but you got to fill out Form 8832 to get the approval of the IRS, okay, and the state. Most states allow single-member LLCs, and that's simply filing Form Schedule C on the 1040. So needless to say, the LLC has become the most popular way of, especially the former sole proprietors entering a new business. Now the next slide has a lot of detail about the 8832, but that will not come when you're forming a business. That will come if you want to change your LLC. So I have that in there for future reference. And if you use TurboTax or some other accounting software, TaxCut, to do your tax returns, those software packages ask you questions and everything else. Now, let's see. Let me. The LLC, you need an operating agreement. This is all asked for in the instructions. The fees is about $250, and then each year it's about, in Connecticut, I think it's $25. Okay. Now you can do landlord. That's if you rent. Again, it's Schedule E, 1040. Each year, if you have losses, you're going to be limited to $25,000. Okay, and then the extra loss is carried over. Nonprofit, the key there is you have to file 1023, Form 1023, either easy or the full one, and that depends on the size of your revenue that you expect to take in through gifts or whatever from your nonprofit. Let's see. So the majority of the businesses, what do? They select the LLC. The goal is often limited liability, and that way you and pass-throughs is 1040. The C Corp can be an advantage if you're very profitable, limited to 21%. The pass-throughs, you have that 20% deduction now. You can close a business and open it under a new form. Experts suggest not taking a salary for at least the first 6 months, maybe the first year, to get your feet settled and see what's going on. And you can delegate responsibility through consultants or hiring, but don't relinquish control of cash. As an example, I worked for the president of a corporation. He was the sole owner for 10 years. I never signed a check. I had to prepare him. He signed every check, and he grilled me as to why we have to pay this check at this time. So that's the way you control your business. For formation assistance, yes, you can go online, and I was amazed at the number of so-called businesses offering you assistance to form a company. They charge a fee, and it's chat room, and it's not face-to-face. So what happens if you have a question after it's formed? So my suggestion is, find someone locally face-to-face. And I mentioned Cliff Anico. He's a lawyer. He's a SCORE webinar presenter. Not to contact him because you want to basically form a business, but he has many webinars and presentations associated with not even forming a business, but business situations that you're in once you're in business. Okay, and he's on YouTube. He's written several books, and he's also on SB TV. Okay, thank you for your attention, and we'll pan through some of these questions and see if we can get you an answer to them.
Great. Thanks, Joe. We're going to use the remaining time now for Q&A, and we'll take as many as we can before 1 o'clock. So, again, if you want to submit a question, you can do so via the chat feature that's in the lower left-hand portion of your screen. and we'll go from there. So, Joe, we'll go back. There were some questions that came in during the presentation, and I'll start with a question from on if a sole is a sole proprietorship required to get an EIN, or is it just a good idea?
It's just a good idea. If you look at the Schedule C, there is a box for the EIN. If you leave it blank, that's okay. They're gonna everything's going to be under your Social Security number. But it's a good idea because if down the road you hire employees and whatnot, then you definitely need an EIN.
Okay, great. Our next one is from Christine Reed, and she says, I'm a sole proprietor and just got a DBA. Do I need an EIN for a business account, or can I just use an SS, a Social Security number?
Well, it's wise to keep business and personal separate. So if you open up a checking account for the business, basically it's best to have an EIN.
Okay. Another one from Kirk Malcolm. In regards to the EIN, you mentioned the business needs to be formed and approved. Who does the approval? I was going to pay for the EIN number today, but did not want to pay for it if there's a missing step in getting the business approved.
You have to get the business approved by the state. So if it's an LLC, if it's a sub S or an 1120C, you have to go to the state and get the approval of the name. Then once you have the name, when you go to the federal and fill out their form, they're going to ask for the name of the business. So the state gives you the name of the business, but it goes through their information, and if someone else has that business name, then they're going to tell you online right away, and you have to choose another one. So your business name in your state is unique. No one else can have that.
Okay, that's great. Question now from Steve Mulligan. What is the difference between a sub-S Corp and an LLC for fundraising, since tax treatment appears to be the same to owners versus members?
Well, when you say fundraising, basically what comes to mind is you're possibly in the nonprofit area. So normally in a nonprofit area, I don't know whether it's mandatory, but I don't have that much experience in nonprofits. Normally the nonprofits are 1120Cs, okay, not an LLC or a sub-S.
Joe, maybe maybe what Steve was meaning there for raising capital as opposed to maybe fundraising. Could you answer from that perspective too?
Yeah. In terms of raising capital, there's no difference. I mean, wherever you get the money, whether it's from a bank or from individuals, then the owners of the LLC and the sub-S, they decide on the arrangements. Like if you got some money from your mother-in-law or something, is it a loan or is it just a gift for you? If it's a sub-S and there's multiple people and they contribute, then it's right in the balance sheet of the sub-S because that's the capital they contributed. The same thing for an LLC. Remember, you could be a sole proprietor, a partnership, or an individual. So the capital contributed by the people that are working in the business, that goes in their capital account and stays with the company.
Okay, that's great. One now from Joe Longo. Is an LLC which provides skill training to individuals required to collect sales tax?
Well, sales tax, that's, I'll say, a difficult question. Someone just asked me that yesterday. First of all, where is your business resident? Then you have to go to the state, and the state has rules as to what services are taxable and which ones aren't. And I know for a fact the state of Connecticut, even if your services are not taxable, you have to file an annual sales and use tax return. And if you don't, there's, I think, a $50 or $150 penalty. So you're not going to collect any taxes for them, but they still want to keep an eye on you this way.
Joe just mentioned that he'd like you to answer from a New York perspective. Do you have a perspective on it from New York as well as Connecticut?
Oh, I would think it's similar. There's a sales and use tax form, then there's instructions. In the instructions, is usually an area where they say these are the services that are taxable and these are the ones that are exempt.
Okay, that's great. We'll turn to a question now from Linda Davis. Can you form an LLC with the S Corp election with two partners?
Well, what you're talking about, from a semantics point of view, we don't call them partners. So if you want to be an LLC and there's two people, you're called members. And then you can form an LLC, and then you have an option. There's two members, so you're not a single member. So you can then choose a partnership, you can choose an S Corp, or you can choose a C Corp. So you get the best of all worlds from the LLC with multi-members.
Okay, very, very helpful. One now from Frank Lombardi, who lives in Connecticut but does business internationally, and says, can I get an LLC from another state? Would there be situations that getting an LLC from another state might be better? Are there special advantages in other states like Nevada?
I'll have to say I'm not going to answer a question. I don't know. I thought the LLC, I thought if the state approves it, then let's say the home office or the business office of the LLC is in that state. So if you're in Connecticut and you're doing business and you want to open an LLC in Nevada, I don't know whether you can do that, okay? I'm not going to say you can, I just don't know.
That's fair. From Jermaine Stone, how do you contact the state for approval of the name you've chosen?
It's online. You just go. Let's say you wanted to open an LLC, and you do it online. Say you have your accountant or lawyer with you, and you put your name in. And the first thing they do is they edit that. Okay. And they don't let you open up an LLC if someone has a duplicate name. I can talk from experience. My daughter has a part-time yoga business, and she opened it up, I don't know, about 3 or 4 years ago, and she had a name. So we put the name in, and they said disallowed. And she was shocked. She thought she had a unique name. So we couldn't continue on the LLC until she thought about another name. We put another name in, and that came back approved. And then we can continue with the rest of the information for the LLC.
Okay, very helpful, and I think also happens quite often. Another question from Kirk Malcolm. He would like to confirm which tax form is the suggested form for two members in an LLC.
Well, I'm prejudiced. I don't like partnerships because there can be too many arguments, and you need a partnership agreement, and you have the SE tax. So, if you have a new business and there's two people, I would like to go to either the sub S or the 1120C. That way, you're both issued stock. You have articles of incorporation. In there is noted the fact that the interest, profit and losses are shared thusly, and if the partner wants to leave, the stock is his, so he can't really leave. He has to sell the stock, or you buy him out, or something like that. So, and then you have limited liability also. So I like those choices rather than a partnership.
Okay, that's great. We still have time for a few more questions, and if anyone else has questions, please feel free to submit them via the chat feature. And Joe, maybe while we're waiting, if I could ask you, could you maybe give some of the common reasons why people might want to move from an LLC to either an S Corp or to a C Corp? What, as they move along that spectrum, what would typically drive that kind of change?
If you're making a lot of money, okay, and this is changing your tax bracket. Say it's a flow-through, and it's changing your tax bracket on the 1040. You're in the 30% now. So what you want to do is you want to take that money off the 1040 and move it to the 1120C, where it's 21%, and then compare the total tax you're paying with the flow-through on the 1040 versus the money off the 1040 but on the 1120C. That would be a good example. So it depends on your 1040, your other income. I mean, if you're married, maybe both spouses work, you have some investments, some dividends, interest, capital gains, and the profit on the flow-through is going to add to that and invariably, raise your tax bracket. So if you're in the 30s, taking that flow-through off and putting on the 1120C and only paying 21% is a very good advantage.
That's great. Very, very helpful. Got time for one last question from Diane Knox. For an individual doing consulting work for large corporates, would you recommend an LLC over an SP? I will not have employees ever.
A single person LLC, if you're never going to have employees and you're not going to bring anyone else, that's the way to start. There's nothing wrong with that. Again, it's easy to form. It's cheap. If money isn't an object, you could be a single person 1120C also. Again, addressing that bottom line, the flow through, what it does to your 1040 in taxes versus moving that money to the 1120C and only paying 21% on the profits.
Okay, that's great. Our time is almost up, and so that's all the time we have questions for today. As a reminder, a recording of the webinar and the presentation materials will be available within a couple of days on the fairfieldcounty.score.org website. You just want to go to On Demand Webinars. Our next webinar will be 2 weeks from today, Tuesday, February 5th, and the topic is Conversational Marketing, Grow Your Business Socially with Facebook Messenger, with Greg Ruiz presenting. Again, remember that SCORE does offer free one-on-one business counseling, so if you would like to take advantage of that, please visit our website and press the Request a Mentor button, and you will be assigned a mentor. It would also be very helpful if you could fill out your evaluations that will be sent to you at the end of this webinar. It helps us a lot with our future webinars. So on behalf of SCORE, I'd like to thank you all for attending today's live webinar. And in closing, big thank you to Joe for presenting today, and have a nice day, everyone.